We'll stay with this and take it further now. Professor Adrian Savill, Professor in Economics, Finance and Strategy at Gibs, joins us live now to continue our discussion. Prof, good evening to you. Thank you so much for your time. Your reaction to the Liberation Day tariffs, as the U.S. President is calling them, and its impact globally?
I think there's a complete misnaming of the day. It might be Damnation Day. It's certainly Havoc Day. That what has been injected into an environment that was already characterized by very, very high levels of anxiety and concern around policy direction has now really been taken a degree further. I think it might be dramatic, just has been taken to the edge. But certainly, this is testing nerves of policymakers, of capital markets, of investors, and it's very quickly moving from Wall Street to Main Street.
And speaking about nerves, right, the presidency in a statement saying that they note this with concern, but also saying the tariffs affirm the urgency to negotiate a new bilateral and mutually beneficial trade agreement with the U.S. as an essential step to secure long-term trade certainty. If these negotiations were to happen now, could they bring the certainty that the South African government is talking about here?
No, that's the hand that the Trump administration is playing, Bongiwe, is that all this requires is a phone call, and if you are on the other side of the conversation and you've brought a proposal to the table that the Trump administration approves of, then we can move on and everything is settled and resolved. So that's the game that's being played. Unfortunately, what's been brought into the setting is very high levels of mistrust. That it's a high-handed approach. It's strong-arming, and that really challenges your ability to negotiate with the Trump administration, or to present a proposal and to go on the assumption that it'll be met by a counterparty that's reasonable, rational, and looking for collaboration.
And when you look at some of the reactions so far, you see the SA motor industry, for example, fearing the worst, given the 25%, that tariff on imported cars and components this week. And then now you do have other industries that are feeling the impact of this, saying that they're now watching this with caution to see what becomes the bigger picture here. So which industries should be watching this very closely and are likely to be impacted here at home?
Well, I think it's, first recognize that the United States is one of South Africa's biggest export markets. And so it's hard for the economy in aggregate to hide. But certainly, as you point out, particular sectors will be harder hit. And then inside of sectors, particular firms. So the motor cluster in general gets hit hard, but big exporters to the United States includes BMW and Mercedes from South Africa. So they are likely to feel much more pain than the rest. The steel sector, the US is an important destination market. Citrus, all the way through to avocados, macadamia, and luxury yachts. So it really is wide-ranging in terms of the impacts, and there's important messages in this for business and policymakers in South Africa in thinking about how to position for this harsh new reality.
And you speak about that. Some of our viewers tonight, we're asking them for their reaction, and they say it's perhaps time for South Africa to be a bit more inward-looking, to start maybe thinking about how to respond even to the uncertainties in future, and potentially think of how you do things a little bit differently here. So how then do we begin as South Africa to have a different positioning here, particularly when you look at business?
There's a couple of things that you could do immediately, in response to a tariff, which is essentially a tax or a price hike on the other side of the table over which you have no control. You could try and reverse out that tariff by reducing your selling price by the equivalent of the tariff. That would be one way. Now, for most businesses, that's simply an impossible ask. They can't cut prices in order to accommodate a 30% tariff. The second is to try and look for sources of different competitive advantage, perhaps to press quality rather than price as the source of your competitiveness. Ultimately, though, what I think it really impresses on South African businesses is they need to be able to demonstrate that they've got a portfolio of destination markets and that they've got various levers that they can use to find positions in markets that are either new or entirely perhaps somewhat known but not saturated. There's tiny elements of redeeming feature in this, and that South Africa does produce some products that go to the United States over which it's going to be very difficult to impose tariffs or to reduce demand, notwithstanding the tariff hike.
I want to get to the
our precious metals would be an example.
Pardon me, Prof. I want to get to the European Union in just a moment, but
Sure.
There's something else that some of the analysts are saying here, is that they believe that now, as they watch the developments around AGOA, it casts uncertainty, particularly on its renewal and its future. Your take?
Well, effectively, I think that this puts a line through AGOA. That we can regard AGOA as a done deal or a dead deal. That's history, because what this does is it replaces the existing agreements with the new administration pronouncements. So it doesn't matter that you can bring an old piece of paper and say, well, we had this agreement. Here is this is a terrible turn of phrase, but here is the new deal.
Sure. And the European Commission President Ursula von der Leyen lambasting the decision to impose these massive 20% tariffs on the trading bloc, saying that it could send the continent on an economic downturn. How do you see this one playing out at a global scale?
Well, first, what really strikes me is the level of economic illiteracy that's being applied here. It's not the case that when you run a trade deficit with a country that it's because you are buying much more from them than they buying from you. It's not nearly as simple as that, because keep in mind that amongst other things, what the United States is doing is they're importing very attractively priced goods. Think of smartphones as a very obvious example. So that plays into very big consumer benefits, notwithstanding the fact that the country runs a deficit, the consumer benefits. The second is that when you impose these tariffs, ultimately, whilst firms will be the first line of impact, it's the household that's the final destination for your products. And so it's consumers, ultimately, the household that will experience this inflation. And I would imagine, just using a back of the envelope calculation, that this is the single biggest tax imposed on U.S. households in probably the last 40 years or so.
And at
a global scale, I think we can square up or ready ourselves for U.S. recession. I think the probability of that has gone to 50-50 odds now.
Sure, Prof. And as some, even our correspondents saying that Apple is now starting to even feel the impact of what's happening there. But thank you so much for your time. As you say, uncertain times ahead. It calls for a bit of rethinking of a number of approaches. Now, I appreciate your time as always, Prof. That is Professor Adrian Savill there, Professor in Economics, Finance and Strategy at Gibs.